Good morning and welcome to this Monday, June 1st edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, lots of interesting stuff going on in the market, that's for sure. Over the weekend, we got some pretty good information out of China. Their factory expansion was greater than expected. So we saw the Shanghai close above 2,900 for the first time since early March. That was pretty big. Hong Kong's Hang Seng Index was up more than 3% overnight. So Asian markets were very strong. We've seen some pretty good action in Europe this morning, although a number of their markets are closed today for a holiday. So in particular, the one I watch closest, which is the German DAX, is closed today, but other markets in Europe were up. We got a little bit of choppiness so far in the futures. We saw them initially open yesterday down a couple hundred points on the Dow, and then they rallied back pretty quickly, went a little positive, and then it's kind of been back and forth overnight. But right now it looks like there is going to be a slight move to the downside, at least as of about 5 minutes ago, with NASDAQ actually looking to open the weakest of the three. But fractional losses, for the most part, pretty small. And then we'll see what happens from the opening bell. A couple of top stories today. We had gambling revenue fell 93.2% in the month of May amid the COVID-19 restrictions. And that was reported by Macau. So you've got companies like, I don't know, maybe Wynn Resorts, which could be impacted by that. Wynn Resorts I've actually been watching to see if we get some kind of a breakout on that stock. But in pre-market action, I think, you might make the argument that a lot of it's already built in because Wynn at this point is actually up 12 cents to 83.40. But I really want to see a breakout above 90 there. So we got some time to wait there. Caesars is planning to open its Harrah's Las Vegas casino this Friday, and initial customer demand is reported to be much stronger than expected. Let's see. Edwards Life Sciences, EW, splitting its shares 3-for-1. I've always been wondering, throughout this huge rise over the last 10 years off the March 2009 low, if any of these companies would start reporting splits. I mean, my gosh, some of these prices have gone crazy, and until we get fractional shares, that's prevalent throughout the market, you would think that some of these companies be talking at least about splitting their shares. But anyway, EW will be splitting their shares 3-for-1. And then also Eli Lilly today came out, said that they are testing a COVID-19 experimental treatment, which is derived from the blood of a survivor of the disease. And that's the first study of this type. Lilly was up a few dollars in pre-market action. So let's see, what else is going on out there? Well, I can tell you later today, if whether you're a member of Earnings Beats or not a member of Earnings Beats, we're actually going to have a session after the market closes today, and it's going to be on short selling. And we've got a chart list that we use. And if you go over to earningsbeats.com, you can see this is the webinar. There's no link in here at this point, but there will be later today. There will be a link to the room. So once we open the room, we'll put the link in here. I would check back maybe around 4 o'clock, probably be open by then. And then we'll get started at 4:30. But I'm going to talk a little bit about the short squeeze. I've had a lot of questions come in. And by the way, this is how I'm trying to answer some of the questions, is through some of our events and some of our webinars, because I'm getting a lot of questions. It's very difficult to get back to everyone individually. But a lot of questions have come in about the short squeeze. I've posted, I don't know, maybe 3 or 4 articles over the last few months about companies as they become what I think are short squeeze candidates when they break out. And you got a lot of folks betting against the company with shorts. Essentially what they're doing is they're borrowing shares and selling those borrowed shares. And the problem is they have to cover those shares. They have to return those shares to their broker. So they've got to buy it back at some point. So you have guaranteed buyers as prices go up. How much pain can somebody take? And when you're short selling, you have unlimited risk to the upside. So it's very different than when you buy a stock. You know how much risk you're taking because it's whatever you put into the stock. But if you short, the risk is unlimited to the upside. So you have to buy back at some point, but the price theoretically could go up to whatever. You could be shorting a $10 stock. It might go to 100 or 200 or 1,000. Where's your threshold of pain when you're shorting a stock? So we're going to talk a little bit about that later today. And I think it'll be a great session. Go over some of the charts that I've posted in the past, that I've written about, and also give you some others that I think are worth watching. We talked about one at the end of last week. It had a really good day on Friday. Breaking out, I think, was up, I don't know, maybe 3% or something. But anyway, we'll go over all that later today. Just come back in and check on this. Check at our website later today after the market closes. It's open to the public, so anyone can come in. The only thing we ask is that you do agree to become a free Earnings Beats Digest member. So if you come into the room and you're not already a member, we'll add you to the list. We'll make sure that you begin receiving our Earnings Beats Digest newsletter. All right, let's move into what happened last week, because it was interesting for sure. The beginning part of the week, and for those of you who are members at Earnings Beats, I mean, our portfolios, for the most part, portfolios have been doing extremely well since they were started. Model portfolio began back in November of 2018. But these portfolios focus on, what's been working in the recent past. So in other words, we're looking for stocks that are showing a lot of relative strength. Well, last week was kind of strange because Tuesday and Wednesday, of course, Monday was a holiday, Memorial Day, but Tuesday and Wednesday, we had stocks that were beaten up badly that were leading the market. I mean, they were just soaring on Tuesday and Wednesday, and the stocks that have been leading were taking a hit to the downside. So I don't know, the S&P 500 was up probably between Tuesday and Wednesday, 2-3%. And our portfolios, I think the model portfolio may have been down 3%. And so it was just really weird the way the market was flipped on Tuesday and Wednesday, but that all changed again on Thursday and Friday. And especially Friday, we saw stocks like software stocks really coming back after some good solid earnings reports on Thursday night. And so it seemed like the market was kind of getting back on track. But for the week, it was just kind of a strange week because, again, the early part of the week, we saw the Dow, S&P leadings, mid-cap, small caps did really well. And then by the end of the week, you can see the NASDAQ on Friday was up 1.29%. But we had small caps down 1%, mid-caps down 0.5%. The S&P was up 0.5%. Dow Jones was down fractionally, down just barely, but 17.5 points. And so, again, the market just kind of flipped itself. I actually think that what was going on last week was very bullish, though, because we already know the companies that have been strong over the past couple months, and we've been talking about them, over and over and over again. We've got a strong accumulation distribution chart list, strong AD chart list that we've been using because these are the companies that the market has been favoring during the pandemic. They did well last week for the most part. More did well than didn't. But what really was encouraging is that a lot of the stocks where we've seen a lot of short selling and we've seen a lot of folks betting against, those areas actually came to life last week, many of them breaking out. And so it's just more and more areas of the market that have a bid under it and, a lot of technical buyers. And I think the more participation that we see in this rally back to the upside, the better off we are. And I think bears are being very hard pressed to keep calling this a bear market rally. I mean, I'm going to go over in a little bit and talk about healthcare, but I mean, we got biotech setting a new all-time high. Healthcare getting ready to break out. Healthcare and technology, by the way, bounced back Thursday and Friday and began to, exert some muscle again, some relative muscle, and they started strengthening into the close on Friday, breaking out to new recent highs. We're going to talk a little bit more about that, but when you look at the action here, it doesn't, I'm just looking at one day, so it doesn't give you everything that happened last week, but it was a pretty crazy week when you look at the volatility back and forth. But overall, I come out of that week thinking more bullish thoughts than I did going into the week. Looking at the sectors, you can see technology was leading. Actually, I don't know why I got them in order the way I do, but healthcare over here also led. And then financials, industrials, and real estate were the three that did not perform well. So these were groups that were lagging throughout the pandemic, and they lagged again on Friday. Technology and healthcare, the leaders throughout the pandemic. and you could see the money rotating back into them at the end of last week. All right, move on to the 10-year Treasury yield. Later this morning, we're going to get a few economic reports. Manufacturing indexes will be out. And sometimes this causes the market a little bit of agony. So the market's already expecting bad news. So I'm not going to be surprised if we see bad news. But we've got the May PMI manufacturing index coming out. The expectation is 39.8. April was 36.1. So we're expecting things to improve. I think the market would probably react negatively if May came in lower than April. I don't think that's going to happen, but if it did, that could be a little bit of a problem. We'll see how that comes out. Then May ISM manufacturing index also coming out later this morning. The expectation is there 42.7. April was 41.5. So again, looking for some improvement in May. And then finally, lagging report coming out of the home construction area. April construction spending is due out at 10 a.m. And the estimate there is minus 5.5%. March was a rise of 0.9%. But April's when things really, mid-March is when things started to really fall apart. And certainly April was a rough month for the economy. All right, let's see, what else do we have? Actually, why don't we just go ahead and jump into the talking technically. I wanted to talk a little bit about the healthcare group. So, healthcare, and a lot of times is short-term traders, and I'd classify myself as short to intermediate term trader. You get frustrated when you're in an area that is sideways consolidating, especially when the market keeps going up, because you're seeing your area sideways consolidate, which means underperformance. If you're not breaking out and the market is, then you're underperforming. But you have to understand with relative strength, that's how it works. When you show relative strength and you're leading, and then you go through a period of consolidation, like the XLV did right here, you're going to underperform the S&P 500. So let me just pull this up. Let's take a look at how that relative strength was looking. All right, so if we pull this up down at the bottom here, you'll see relative strength. But you see how the healthcare back in March, from the March low through the April high, I think it was pretty clear that we had tremendous relative strength. And even during the sell-off, most of the sell-off, you can see tremendous relative strength in healthcare. So healthcare has been kind of a safety net for traders throughout 2020. But if you didn't pay any attention to what was going on in price action, you just looked at relative strength, this might concern you, because you're saying, well, why is healthcare underperforming for the last 5-6 weeks? Doesn't make any sense. Well, it does when you consider that as the market keeps moving up and money simply rotates for a period of time out of healthcare, you're going to see this relative strength line deteriorate. What you really want to pay attention to, though, is does the sideways consolidation result in another breakout or a breakdown? If we had broken back down below these lows, lost the 50-day moving average, that would have been a completely different animal with relative strength going lower. But in this case, you can see the end of last week, we actually turned back higher and broke out on the XLV, and we are not far now from breaking back above the January, February tops. That would be incredibly bullish to have a major sector breaking out to a new high, and I think it's coming. I just think it's a matter of time. But for now, I just liked last week in the near term seeing that breakout to the upside. And with that breakout, you can see that the relative strength picked back up at the end of last week. So that is more important to me. I want to see the actual breakout on the absolute chart and then see the relative strength returning. And that's what we saw at the end of last week, when I'll be looking to see if that continues this week. So within healthcare, what's it look like? Well, if we break it down into the various industry groups, let's start with medical equipment. So medical equipment, you can see, also deteriorated quite a bit for about 5 weeks, but it was just consolidating. I think it's asking too much to expect a group just to go up every single day without a pause. It's actually good for the market to see basing take place in some areas of the market and then another breakout. And that's exactly what we saw with medical equipment at the end of last week. So I was pretty pumped by how the market reacted at the end of last week. I was not at all pumped by the way our portfolios were performing Tuesday and Wednesday, but it was nice to see them rally back on Thursday and Friday. And actually, the aggressive portfolio wasn't far from outperforming. And considering the backdrop of what happened last week, I thought that was pretty bullish. All right. So that's your medical equipment. I think medical equipment looks very good. You still got your PPO above the center line, so you've got positive momentum. You got the breakout, which I think could lead to some additional gains. I would now be watching that rising 20-day moving average. I think that will hold on any pullback. But let's take a look at the other areas. So let's pull up the biotechs. This is my favorite area in the healthcare. I like medical equipment too, but I think the biotech area breaking out to a new high in this environment, the volume picking back up. And I know there are probably some technicians looking out there right now at this chart and saying, what about the negative divergence? Well, there is a negative divergence by definition. You've got higher prices, you've got a PPO that's lower. I would be more concerned with that negative divergence if recent price lows don't hold. So I'd say if the biotechs go back down and close below 2,300, then I think the odds increase that we're going to get a centerline retest and a 50-period test. But it's hard for me to argue that we have slowing momentum when we are breaking out to a new 52-week high. The market's not breaking out to a new 52-week high. So obviously we have relative strength. And look at the volume pick back up on Friday. Can you really argue slowing momentum? That's what a negative divergence is telling us. It's telling us that they're slowing momentum. Slowing momentum based on price action. The PPO, MACD, whatever momentum oscillator you like to use, they don't take into account volume. They only take into account price. So, and I would argue that a breakout on the biotechs to a new 52-week high on 17 billion in volume would be different than if it was 8 billion in volume. That, to me, light volume breakout would be much more nervous about this move. But I don't know. I find it very bullish to see the volume high and breaking out to new highs. Divergences, momentum oscillators, they are secondary indicators to price action. You know, this is probably the one thing I wish I could maybe get across to more folks more often. Maybe I don't say it enough because I get a lot of questions. How can you like this stock? There's a negative divergence. Well, if a stock's breaking out with big volume, to me, the negative divergence is worth noting, especially, again, if you can't hold a breakout, you start reversing back down. That could be a bad combination. But if you're breaking out with heavy volume, that, to me, takes a backseat to the breakout. Because what happens a lot of times is you'll see a negative divergence like this, and then when you get the price breakout, if we keep moving higher, that PPO will start turning up, and all of a sudden, a week later, there is no negative divergence. It gets eliminated. And then you're sitting there, you're out of the stock because you saw a negative divergence, and the stock took off or the index took off without you. So I think you got to, you know, it's a balance. It's a puzzle that you put together with the stock market. It's not, okay, I saw this on the one indicator. That means I'm getting out. I think that's a bad way to look at the market. You really want to put all the pieces together. All right, so what else do we have in that healthcare area? How about healthcare providers? Healthcare providers made the breakout on Wednesday, breaking out above consolidation. And I see off of this uptrend, equal highs, rising lows. I see an ascending triangle. I think we're going to easily go back and test that 23 plus area on the healthcare provider index. And let's see, how about, what else we got? Pharmas. Pharmas are still consolidating. I like that candle from Wednesday, though. I always like it when you get these false breakdowns like this, come back up, hold, and then you can see the rally that ensued afterwards. Not my favorite group. We haven't broken out. Others are. So I would maybe have the pharmas a little bit behind some of the other healthcare areas, but I still like the pharmas. And then the last one, this is a group that had been lagging all the other healthcare industry groups until recently. And now medical supplies. Look at the breakout. The breakout here occurred over a week, maybe close to 2 weeks ago. And look at the relative strength, breaking out above all of these highs. So now we've just moved to a new relative high in medical supplies. So if you got medical supply companies out there that you like, I think the index is certainly supporting that. In fact, if the index pulls back and you get some good solid reward to risk entries into medical supply companies, I'd be interested in that for sure. All right, let's keep moving on. How about earnings spotlight? Got a few companies, actually just a couple of companies reporting today. I'm going to just go over these and take a look at what's going on pre-market. So Auto Home, I didn't get the numbers today on the stocks, but there are only two that reported. But you can see Auto Home down about 0.5%. I would watch 72.5 to the downside, 82.5 top side. I just think we're chopping in here in the sideways consolidation area. And this is after an uptrend. So anytime you uptrend and then you go sideways for a period of time, my instinct is to bet on a move to the upside. So if I was going to do anything with this stock, I would consider buying it as it moved down closer to the 72.5, 73 area. The other stock that reported, and I think they missed, I think I may have seen a headline on this one, but Embraer Aircraft ERJ down 3%, 17 cents to 532. And I think it's pretty clear this has been an underperformer for quite a while. The stock went up, tested its 50-day moving average, came back down, closed at 549 on Friday. Now I would watch that 20-day moving average. I do not want to see the stock move back down below the 20 and especially stay there for a few days. That would, to me, signal perhaps continuation to the downside. Wanted to mention tomorrow, there are some companies coming out later in the week, some really important earnings, especially for those of us like me who have been following some of these pandemic stocks that have done very well. We've got some reporting this week, and I think they're going to be really worth keeping an eye on. Tomorrow, I would say the biggest report for me all week is going to be Zoom, which is ZM. They broke out again on Friday. I saw earlier the stock was up this morning. They report after the bell today, or actually tomorrow. They report after the bell. I'm pretty sure it's after the bell. You might want to double check me on that. But they report tomorrow. And this is a company, this was one of the first that, in my opinion, just said, we actually like the pandemic. The pandemic has fallen into our laps. This has actually been something that has helped their business. So with everybody working from home, people in stay-at-home mode, lots of orders around the country to stay at home, businesses didn't completely shut down. A lot of them, we were doing a lot of our collaboration online. And Zoom is like the poster child for this. I mean, a lot of these, you turn on, I don't know, some of these shows like American Idol or The Voice, or you look at some of these sports shows or whatever, and you see all of these shows being done using either Zoom or Microsoft Team, those types of platforms, these online platforms. And I mean, I know the number of subscribers for Zoom has gone through the roof. Has the price built all of it in? Or are we about to see a number that comes out tomorrow that suggests Zoom should be 200 or 250? I mean, I think this is one that could go a lot of different ways. I like Zoom. I own Zoom. I think this is a company that goes higher with its earnings, but that is a risk because this is one that literally could go either way and could go crazy. I mean, we could see a huge gap up followed by a major sell-off. We could see a big gap down with buying coming in afterwards. I have no idea, but what I do have a pretty good idea of is that this is a stock that since January has gone from 70 to 180. Wall Street knows that they've got good numbers coming out. The question is, do they continue to go higher after those numbers are reported? And I think that's going to be, the question for a lot of these companies that report this week. Another one that reports Tuesday is CrowdStrike, CRWD. Another one that's been on fire since that March low, was down at $32. Now it's at 87. We're talking 2 months later from the bottom of this pandemic. So CrowdStrike, definitely the market looking for good numbers here. We'll see whether we get them. Later this week, we've got a couple of software companies. How about DOCU? This is DocuSign. It's in one of our portfolios. I love this company. Breaking out on Friday. Look at the volume picking up. But it's a stock that's gone from $65 in March to $140, more than a double. Is all the good news priced in? Or when earnings come out, do we see another level to the upside? How about Slack Technologies? Another one. I really love this stock. And I'm in Slack, WORK. Broke out big volume on Friday. This one's been trading really nicely. It was one of those stocks that was getting hit back in March, but we noticed accumulation distribution was going up. So this has, again, been one of those poster childs for this pandemic and how online collaboration has helped some of these companies tremendously. How much? We're going to find out on Thursday with Slack. Another company in telecommunications, Ciena, CIEN, another one of our portfolio stocks. Look at this stock. It's been on fire. They come out with earnings. Will they be higher? I don't know. We'll see. All right, let's go over some upgrades and downgrades. Got a couple here. First, we'll go with Estee Lauder, EL. Stock being upgraded today. I loved this breakout above the 180 area, and stock really had a great week last week. I think at some point we'll probably get a little bit of a pullback. Going to be maybe a little difficult, we'll see, to get through this reaction high off the gap down back in February. So I would see maybe 203 being a little bit of short-term area of resistance. If we go up above that and pull back and close below 200, I would be thinking maybe short-term top. Anytime I get a key area of resistance cleared intraday and then fail to hold it at the end of the day, I look for short-term weakness. If you're holding a stock like that long-term, you're thinking months or years, I wouldn't care, don't pay attention to these short-term candles. But if you're a short-term trader, yeah, I mean, it makes a big difference if you've got a stock at, goes up to 204, comes back at 199. If you get out at 199, you can get back in at 185. That makes a big difference. So, those types of candles you want to watch for as a short-term trader. KEYS, this is Keysight Technology. I know I talked about this one last week with earnings when it was gapping down. I said I wouldn't be surprised to see this one rally back. Well, it has rallied back from 97.5 to 108. Today they get upgraded. Think what you want, but I've seen this so much, it doesn't faze me anymore. But a lot of these companies that have been strong, when they do gap down with earnings, many times that does signal a pretty good opportunity to get in at a lower price. Alta upgraded today, ULTA. Alta recently making this breakout above prior highs. Pulled back a little bit on Friday, then rallied into the close. Volume you can see picked back up again. This one, the accumulation distribution just finally starting to turn back to the upside. And I'll be honest, I'm not following accumulation distribution as much now as I was a month or two ago. I still like our strong AD and our weak AD chart list. I'm not changing a thing there. I've kind of thought about it, and I don't want to add new stocks based on stronger AD because I really think I want to keep the stocks that did well during the pandemic. I want to keep those separate. I just want to kind of let that chart list sit by itself for a while. I don't want to update it because I think that the signals that they gave back in March and April are still true to today. I think there was a reason why those stocks were accumulated for this pandemic. I think we got a paradigm shift. I think many of those companies will continue to do well for quite a while. So as far as, because we've been using that accumulation distribution indicator a lot the last couple of months, I'm getting a lot of questions from members now. Look at this stock, the AD line's turning up. And I'm not, I think that we were in a unique situation back in March and April. And for me, the accumulation distribution line was an indicator that really separated the strong pandemic stocks and the weak pandemic stocks back in March. Now, what's going on with the AD line is not as meaningful to me. So if you're not seeing me use it as much as we go forward, that's why. Downgrades, I just want to mention CGC, Canopy Growth, 4 downgrades today, 4. Don't usually see that many downgrades of a stock or upgrades of a stock at one time, but 4 downgrades. Stock had gapped down, finished below its 20-day moving average, almost right on its 20-day moving, actually a little bit above its 20-day moving average, but very close. Huge volume. Stock was on a roll, but the overall trend is down. I would be careful with this stock if it stays below that 20-day moving average. I want my stocks to, for the most part, stay above the 20-day. I feel better trading on the long side when my stocks are above the 20 is rising, the 20 is above the 50 is rising. That's what I want to see. That's momentum to the upside. So I don't know, CGC with all these downgrades, I'd be a little careful. All right, last thing, 3 you must see. Go through these kind of quick here. First, we're going to look at Manpower, MAN. I talked earlier about seeing a stock make a breakout intraday above prior highs. Look at what happened on this stock last Wednesday. It failed, came back down, closed at 74. And you might think, well, maybe I'll wait until it gets back up to 76, 77. Well, we never went back up and set a new high. And you can see what happened a couple of days later. Manpower comes back down. I think as a short-term trader, you have to pay attention to these false breakouts like this. Another one is Lockheed Martin. Lockheed Martin, look at this, gets back up. See how we could not get through 400? Here we went up to about 401, 402. I don't know what the high was there, but we failed. Came back down, failed to hold, and then the next day, you can see we were down another $7. I actually like Lockheed Martin. I'm not a big fan of defense stocks in general because they've been downtrending, but Lockheed Martin has been one of the leaders in the defense area, and I would be very bullish on a breakout above this 400 level. Or the alternative maybe is to see if that 20-day holds. If it pulls back and tests that 20-day, you might get a pretty good entry. And then the last stock for the three you must see is Cigna. Cigna, same thing. You know, I'm just trying to point these moves out here. When you get these false breakouts, see that false breakout got up to about 205, cleared that intraday high, came back down, couldn't get the close above the 200 level, and now for the second straight day, we're seeing a little bit of weakness here in Cigna. I think we could see some buyers coming in at that 20-day moving average. I'm okay with Cigna. I think Cigna has been a pretty good performer. The healthcare providers group has been strong in that healthcare sector, which I talked about earlier in the show. Is Cigna one of the best? No. I'd like to see it hold on to its relative strength line here, but it should benefit. You know, when your industry group's going up, I think, in my opinion, you have a better chance of going higher to follow your industry group. And so I like healthcare. I like the healthcare providers group, but this was an underperformer and it had a false breakout. And that's important as a trader to realize that. All right, the market is open. Let me just give you quick opening numbers here. Right now we got the Dow down 88 points, the S&P 500 down 8, NASDAQ down 9, and NASDAQ 100 down 18, which is actually better than the Dow and the S&P on a relative basis, looking at the percentages. Small caps and mid caps actually green right now, so seeing a little bit of leadership there. All in all, I would expect to see a strong week this week. I just go with the trend. I mean, the market's doing well. Yeah, we're overbought, probably some areas of the market more than others. But probably I'd say my focus this week is going to be on, do the strong AD charts do better than the weak AD charts? Do we see a resumption of money rotating back into some of those areas, especially with some of the key earnings coming out that I talked about? I mean, we got Zoom, DocuSign, Work, which is Slack Technologies. I mean, these are companies that have kind of been leaders in the face of this new paradigm. And are they going to be bid up after their earnings, or is the market just going to say, well, it's one and done for these companies? I don't believe it's going to be one and done, but we will see what kind of reaction we get. So that's going to be pretty important. All right, and you can see now NASDAQ has just turned green. Anyhow, everybody have a great day. Be back tomorrow over at Stock Charts TV. And again, remember, today after the close, 4 o'clock, come on over to earningsbeats.com. Check into our room. We should have a room link up by then. It's a free event for everybody. Want to just show you a little bit about short squeeze, how it works, and show you our chart list, which is pretty powerful. Anyhow, again, everybody have a great day. Be back tomorrow. Take care. Happy trading.